Hey folks, hope you all are doing well. I'm Karan Bandal from Econosite, and in this video, let's talk about the investment options available to a Chinese citizen and its potential consequences as things stand towards the end of 2024. This will be a two-part video. In this part, we'll talk about the investment options. The next one will reveal the consequences. If you are a wealthy individual in China right now, possess a sizable capital that you want to put to work, you might be in a pickle because good investment opportunities are nowhere to be seen. Broadly speaking, I can think of three buckets to put one's money in. Number one, Chinese equities or private Chinese companies. Number two, government investment vehicles like central government bonds or local government bonds. And number three, property or real estate. Then there are alternate investment options like gold, cryptocurrency, luxury watches, vintage wines, etc. But even the ultra wealthy invest no more than 10% of their assets in these alternate investments. I talked about how the investment portfolio of an ultra wealthy individual looks like in this video. Check out the link in the description below. Point being, the three buckets that I just mentioned realistically are at your disposal as an investor in China, and all three more or less are in distress. Let's start with number three, real estate. Since it's quite clear by now, China's real estate sector is in recession to say the least. Some of the biggest property developers in China have defaulted in some form on their debts. China has built 90 million more houses than needed, another 20 million bought by people but never completed. Such is the state of oversupply, the effects of which are visible in property prices throughout China. Look at China's property price index performance starting in 2005. In the last 19 years, this index has gone up only 12.5% in total. That is roughly a mere 0.5% of annual growth. And the same property price index, after hitting a peak in Q3 of 2021, is now down over 12%. Who knows how much lower this can go? People in China have close to 70% of their wealth tied in real estate. And barring tier 1, tier 2 cities, they have had a rough experience investing in property. So real estate is clearly not a promising option. Let's talk about option number one, Chinese companies. We can gauge the performance of investments in major companies in a nation by looking at broader market indices. For example, Dow Jones or S&P 500 in the United States, BSE Sensex in India, and one of the main indices in China, the Shanghai Composite Index. If you had invested your money in Shanghai Composite Index about 30 years back, that money would have grown about 4.5 times by now, or about 5% every single year. During the same period, India's Sensex would have grown your money about 22 times, or roughly 11% per year. Now, adjusted for inflation, real returns would be lower in both cases. In case of the United States, S&P 500 has returned over 7% in the last 30 years, adjusted for inflation. So China's index has demonstrated a lackluster performance, and it never recovered after hitting a peak in 2007. Again, not an attractive option to invest in. Finally, option number two, government bonds, a relatively safe investment bet. Here as well, there is a problem. Government bonds issued by the central government or listed bonds issued by local governments are still safe, but they return 1 to 3%. Not great. Local governments in China raise money using something called as LGFV. Some LGFV products are non-standard. They are not listed on public markets, but are sold directly through banks and securities firms. The size of this non-standard local debt market is estimated to be somewhere around $800 billion. That's massive. Clearly, a lot of Chinese are investing in this opaque corner of the local debt market. The draw of these non-standard LGFVs is that they typically pay about 7 to 8% in interest. The problem? Number of defaults in this space have gone up 20% in 2024 so far. These are the local government bonds issued by China's cities, towns, and provinces. A well-run government is not supposed to default on its debts. Lulu Fang, a 60-year-old owner of a small trading firm in China, lost her life savings of over $2 million after investing in one such product. This is only one of many examples of retail investors in China losing money in this space. Where does one invest if even the safe forms of investment start morphing into risk assets? In summary, for a wealthy Chinese individual, are there no safe havens left for their capital in China? China's real estate is in recession, the equity market appears to have stagnated, and the safest place to park one's money, government bonds, are either defaulting or have poor returns. In part 2 of this video, we'll talk about the consequences of it all. I hope you found this analysis interesting. I'll speak with you again next week. Until then, take care.